Financial bubbles, akin to a dark, exhibit distinct characteristics that can help identify their existence and potential impact on markets. These bubbles, driven by a collective enthusiasm or speculative behavior, can lead to unsustainable asset price increases and subsequent market crashes. I should put in a disclaimer that this episode and all episodes in this series are not meant to offer any financial advice to anyone. Financial bubbles often manifest through specific indicators and behavioral traits. Rapid asset price escalation fueled by investor psychology, specifically the fear of missing out, irrational exuberance, and speculative behavior are a common feature. Additionally, increased trading volumes, excessive leverage, and a disconnect between asset valuations and fundamental factors may signal the presence of a bubble. By examining these indicators, investors and analysts can gauge the likelihood and potential severity of a bubble. Several notable historical examples illustrate the impact of financial bubbles on markets. The tulip mania in 17th century Netherlands, the South Sea bubble in 18th century England, and the dot-com bubble of the late 1990s saw an unprecedented surge in prices. In the dot-com bubble, companies with little or no earnings were valued at exorbitant levels, reflecting speculative fervor. When reality set in and investors began to question the sustainability of valuations, the bubble burst, leading to significant market declines. Another pertinent example is the housing market bubble that triggered the global financial crisis in 2008. Easy credit, lax lending standards, and a belief in perpetually rising home prices led to an unsustainable surge in real estate values. However, when the underlying mortgage-backed securities turned sour, the bubble collapsed, causing widespread financial turmoil and recessionary pressures. Financial bubbles carry significant risks for economies and financial systems. When bubbles burst, asset prices decline rapidly, leading to substantial wealth erosion for investors and potential financial instability. The aftermath can result in reduced consumer spending, business investment, and employment, contributing to economic downturns. Bursting bubbles can have a cascading effect, impacting other sectors and markets interconnected with the initial bubble, amplifying the systemic risks involved. Detecting financial bubbles in their early stages can be challenging, but is crucial for mitigating their adverse effects. Market participants and policymakers can employ various strategies to identify and address potential bubbles. Robust risk management practices, including stress testing, scenario analysis, and careful monitoring of key indicators, can help identify vulnerable areas within the financial system. Furthermore, effective regulation and oversight are vital for maintaining stability. Regulatory authorities should ensure that lending standards remain prudent, monitor excessive leverage, and implement mechanisms to detect and address asset price bubbles. Promoting investor education and awareness can also aid in mitigating the impact of speculative behavior and promoting more informed decision-making. In conclusion, financial bubbles resemble a dark in their observable characteristics and behavior. By understanding the key indicators and behavioral traits associated with bubbles, investors and analysts can better identify their presence and potential risks. Historical examples such as the dot-com bubble and the housing market bubble highlight the consequences and risks these bubbles pose to economies and financial systems. Strategies for detecting and mitigating bubbles include robust risk management practices, effective regulation, and investor education. By carefully monitoring and addressing the signs of financial bubbles, market participants and policymakers can work towards a more stable and resilient financial system. That's it for today's video. I hope you found this analysis insightful. If you did, please like this video and don't forget to subscribe to our channel for more engaging content like this. As always, I appreciate your support.